Today we're going to be talking about liquidity. If you want to master the art of six-figure trading, you have to master liquidity. It really is the difference of you being just an average trader or a really great one. And if you constantly feel like you're missing huge move after huge move, or the market's always doing the exact opposite of what you're doing, chances are you are missing the mark on liquidity. And look, I totally get it, because I spent the very first 6 years of my trading career chasing the ghost of liquidity, reading every book, buying every course, only to end up feeling like a mouse in a maze chasing this invisible piece of cheese. I had lost so much, so often, for so long, I swear, I could have had the market arrested for cruelty. And it wasn't until I met an institutional trader who sat me down and told me the truth about liquidity that I realized just how misunderstood and misused this concept was. And I'll never forget what he said. He said liquidity is like the Walmart of trading strategies. It's one huge warehouse filled with aisle after aisle of just nonsense. And there you are, just pushing your cart through all of that nonsense, hoping you find what it is you came to look for, when it's just so much easier to go right to where it is you need to be. And right there, that was the answer I was looking for. Because I realized that all of the trading strategies that we learn when we start trading have us looking at liquidity in the past, when what we need to be doing is going right to where liquidity will be, long before it's happened. It's that simple. By the way, my name is Doug, and I've been a professional trader now for more than a quarter of a century. This is all I do. And today, I want to hand you the exact same cheat code that trader gave me that day. I'm going to show you the easiest way you can find liquidity long before it happens. And after this video, you'll never ever have to stand in that cesspool of nonsense ever again. Now, before we dive in, I need to start by showing you the common mistakes we all seem to make when it comes to learning liquidity, and why this concept is so confusing, so misunderstood, and so misused. And I need to start here because if we can understand the mistakes that we make, when I get to the part about explaining liquidity to you, it's going to make so much more sense, and you're going to be able to use it a lot better. So right here on your screen, you're going to see a current chart of the NASDAQ 100, the QQQ ETF. That's what I'm going to be using for today's example. The asset doesn't matter. I'm using a 5-minute chart. That doesn't matter either. All that matters is you try to internalize the concept right now. And just for reference, I'm using the Thinkorswim software. So these gray highlighted boxes that you see here on the screen are pre and post market activity. And the highlighted black area is the official market hours. So what I want to start with is proposing to you the same very question that was proposed to me by that institutional trader, which is, if I'm to ask you, where do you think, based off of this chart, where do you think the liquidity is? So just take a moment and think about that. Where is the liquidity? Do you think it is at the previous day's high, the previous day's low? Is it at the pre-market high or the pre-market low? Or is it at the current day's high and the current day's low? Like, which one of those is it? Now, to speed along here, no matter what you said or what number came out or where you pointed to on the screen, it's all correct. Because the answer is liquidity is everywhere. It's like the Matrix. It's all amongst us. Because the definition of liquidity is how quickly an asset can be converted into cash, how quickly you can buy an asset or sell an asset. So when it comes to something like the NASDAQ, the QQQ, whether you want 100 shares, 500 shares, 2, 3, 4, 10,000, whatever it is us retailers want to trade, we have no problems getting in and out of that size. And I'll show you. If I pull up the timing and sales, you'll see there are tons and tons of orders flowing on every single penny. So that is liquid enough for us. So right there, the first step in us understanding liquidity is when it comes between you and I, the retail trader, this stuff is irrelevant. It doesn't matter to us in terms of us making a trade or us getting into a position that we want. So we have to understand, well, who does it matter to? And the answer is the institutions. You see, because their sizes are so big and their volume is so big, they actually need to create the opportunity they want to get the opportunity that they need. So they're not really looking at liquidity. What they're looking at is actionable liquidity. They need to create an action in order to get into the trade in the first place. Now, an easier way to look at this is wait versus create. Now, think about that as when we enter a trade. What are we told as retail traders? to wait, right? Wait on your A+ setups. You hear every guru saying that. So what we're doing is we're waiting for a pattern to develop. We're waiting for an indicator to show up. We're waiting for some sort of candlestick formation to get into a trade. Once we see what we need to see, we hit the button. We in, we out, we out, we in. It's that simple for us. Not for them. They have to create the trade to get in the first place. Now, you may know that to some degree, but here's the real problem. The only way this actionable liquidity can ever take place on any level, the only way they can ever get that opportunity is the masses must be stopped. Everyone needs to be run out of their trade. These institutions and funds need the long-standing tradition of 90% of traders fail. They need to continue that tradition in order to make money. And if you're using standard technical analysis chart setups, you're using standard liquidity strategies, they already got you played. They already know where you are. They already know what you're going to do long before you need to do it. And they're just going to steamroll all of you out of a position. That's why most of us lose when we start trading. Now, let me show you exactly how this plays out on the chart. So from this moment on, you'll never ever have to worry about being on the ass end of a trade again. Now let's go back to this QQQ chart and talk about the sizing issue. It's very important to understand this so you'll see how these moves are manufactured in the first place and you'll know what to look for. So let's say just for this demonstration right now, there are two sides to this trade. There is one who would like to purchase 200,000 shares, a very sizable position in the QQQ. They want to buy it. And on the other side of this, there's an institution out there that would like to sell 200,000 shares, another sizable position. Okay. So as we established earlier, let's just kind of talk about the buy side trader, the buy side institution first. As we discussed, in order for this to ever become a reality, you must have 200,000 shares to be sold. Okay. Now you may look at the volume down at the bottom like I used to and say, well, there's plenty of volume. There's like 500,000 every 5 minutes. It should be easy peasy lemon squeezy, but it's not. Because this is not the only institution that wants to pull this. There are thousands upon thousands all over the world that want the same exact trade. So one kind of benchmark is the power of 10, maybe even 20. In order for that one institution to get 200,000 shares of sell-side volume, they need like 3 million sell-side shares. And as we discussed, the only way anything like that can happen is some kind of fear has to show up to get everyone out of that position. This is a very difficult thing to do. So maybe I huddle up early in the morning with my market maker friends or my other institutional people and say, I don't know, we got to tweet some bad stuff. Maybe we should post some articles about some tariffs. Let's get these people off of these positions and start to see some selling so we can start filling. Now, most of you might have that idea. By the way, the sell side needs the opposite thing. I got to get everybody to buy this. I need to create some good news. I'll get this thing to rally in order for me to get these shares. We'll talk about that in a second. Now, some of you may know this, and that's understandable. Let's talk about how that's manufactured. So you'll see here earlier this morning in the pre-market, you started to get this really dense, strong selling. And that's usually the key. Any sort of aggressive, continual, the key is continual, consistent momentum move downwards is something that probably in most cases needs to be reversed. I know this is not what you're taught in most cases, but this is actually what needs to happen. Vice versa, any continual momentum rally often is used to sell because that sell side wants to get in on that trade. And I'll go into this here in just a little bit more depth. The question that you're going to ask yourself right now that we must establish once we see the move, because to me, I find this to be very, very simple. By the way, this move is something I refer to as lead candles, which draws our attention to the trade. This lets us know a trade is in play. You may have heard different lingo like liquidity grabs, liquidity runs, manipulation. All this stuff is true. It's sad, but true. And this is the other side of the game that we have to understand in order for us to play it properly. So let's talk about how do we know that what we're seeing isn't the next market correction. And I'm not going to get into a bear market and just get blown out of the water, or vice versa. I'm buying all-time highs and I'm going to get cheesed. Well, the easiest way to start, or the first principle to start with, is support and resistance. This may be something that you've heard, but it is true that usually the support, the past support, the previous day's high, the previous day's low, are good places to start because that is where most people put their stop losses. That's known. So that's kind of a little bit of advantage for you. And you'll notice today, right there, you tapped right into the previous day's low and then you got this rally. But that's not going to be enough. You just can't say, hey, every support must hold, because remember what I said just a little while ago. This liquidity is kind of organic. It can emerge anywhere it needs to emerge. Maybe, and what I'm saying is maybe actually, let me back up. Once all of these orders have been filled, let's say all the people that manufactured this sell-off in the morning, all of them got filled somewhere in this area. Once their orders are filled, whether it's at support, right before support, right below support, that side's done. That sell is over with. That's the key. It doesn't have to be at support. It doesn't have to be below support. It can be before support. It can organically be created, and that's the message I'm trying to bring across to everyone. It can be organically created everywhere. This is where we get confused. It doesn't have to hit things to the penny. This is why I've said in the past, technical analysis is not literal. You're looking for the signals. Now, I want to magnify this here and show you these signals. So not only did this emerge at the low of the day, let me open that up so everyone gets a nice viewpoint. Take a look. I've done tons of videos about this. You can always go back through the channel. You can learn things about the John Wicks, the power of towers. But notice all of the wicks, the tail wicks down at the bottom. Notice that all of the pressure was trying to move lower, right? And get that instrument down, but it couldn't happen. Now, here's a different way to look at it. Instead of going into a whole candlestick class, I've done tons of candlestick charts. Here's what I want to do just for everyone to get on the same page. There are a few pieces of this. How you know is speed, which is momentum, the candlesticks that I'm showing you right here, and the time of day on the clock. If you can combine all of these together, you're going to get the answer. Let me try to do my best to explain it. As this is moving lower, you'll notice the very first, I want to open this up because this is important. We've got to see this. Excuse me for just 1 second. Let me do this. So as this presses lower, you've got your first sign of a buyer. This is why wicks to me are so powerful. And this is the 30, 50% retracement of the bar. So if you haven't watched those lessons, let me just give you the brief. At one point, you're looking at a very robust red bar. But right there at that support, someone snuck in, bought it back up. That means there was a lot of buy-side volume, obviously. Now, that took place at support. That buy-side volume could be lots of institutions, which it is. Could be a lot of retail traders who are trying to bounce this and buy it off support. Easy stuff. But that doesn't mean it's going to hold. Notice that back here, the next bar gets just slightly underneath of that. Now, that right there is probably what you hear is the trap bar, because anybody who may have bought here probably just layered a stop a tick, a point or two, just slightly underneath of that. They get hit, and then back up this bar goes, right? A third bar comes in, tries it, a fourth bar, right? Doesn't even work. And even if you have two more here, it's actually 5 total bars trying to get it. So it's kind of speed ahead. If this move, here's how these moves work, even the up one. Usually what you see in 90% of the stuff you trade is an upward burst of momentum and stops, a downward burst of momentum and stops. That momentum, once it stopped and was unable to continue to go through to the downside, meant for this pocket in time, the sell-off is over. Those orders that were manufactured in the pre-market to create the selling, those orders have been filled. Everybody who wanted to be in, who needs to be in, is now into this trade. It isn't going lower. This is why the biggest disaster for you traders is to try to short way down in the hole like that. You're going to get murdered every single time because there's only a few cases where it'll just blow through. That may be your next question. And if I back it out, you'll see the difference that once there was no more momentum and upward retaliation, you just kept blowing through the downside. You see that? Now we'll talk about this move here in just a little bit, but back to this one. Once this move has been made, that meant everyone was in. Again, via the wicks, the multiple tests of support, the back support, and actually you'll see right here on this big candle, if I just draw this down, you had really strong spikes in volume off that buy side candle. So that meant, those orders were getting filled. Those are the tactics we use to get into these trades. Here's something you may not know. Again, this stuff is kind of known by a lot of people. I'm not the first one to tell you, but here is something different. What you must know is that once these orders have been filled, they're not rebuying once this takes off, okay? The other thing to look at is the market always likes to screw as many people as possible. there's going to be a lot of those funds and institutions that didn't get their order filled, right? Let's say you got 100K filled, you're still 100K short. Hopefully I'm making sense here. Once you move up here, this is what I'm about to tell you. Once this has broken that high of day range and gone impulsive, there are no buy side money coming in there. If the person missed 100% of the fill, they're not in it. They are not going to. Institutions will rather die than chase. Trust me. They're told, trained, no, you don't chase. So if you're in, great. If you're not, tough. You're going to wait. So that means what? All of this upward move has one retail buy side and who? Who's now looking at the other side? That 200K seller. That 200K seller is now reverse engineering because now they have the upside liquidity to start leaning into the sell. Does this make sense? So the early morning pre-market move created the buy side liquidity. It bounces. The buy side liquidity traders, the hedge funds, they say, we already rallying. We're not chasing. That's for retailers. That's what we trained and told them to do. The sell side people come in. They start to suppress. How do you know? You reverse engineer the move at the bottom. Let me show you the move you've got and show you the trap. Once you get up here, notice the reluctancy to try to push through. The speed, the momentum has stopped. It might go 1 or 2 ticks above. Of course, it's going to go 1 or 2 ticks above, just like it went 1 or 2 ticks below. It stopped out all the longs. It's going to stop out all the shorts too. This is the game. But the sell-sider is slowly wiggling in to these 200,000 shares up here. You know it by the time, the speed, the momentum. Once this move has gone up, it started to slow its pace down. You need to look at these moves in real-time environment. One thing that's often left out in all of our studies is speed. Speed is a gauge of emotion. The faster something is moving up, the more it's in there, the more emotion is in there, the more fear is in there, whatever it might be. When that momentum slows, that means the general consensus of the market's starting to back out. So in this upward move, the retail traders have we don't have enough money to push this up. And now the sell-sider is coming in, just keeping that thing compressed. This is why flag patterns or wedge patterns really don't have a great, I don't want to say they're not useful, but they only really work in super, super strong bull markets where the institutions will willingly uppace. So let me give you an example of that. Notice this is a flag pattern right here, a failed one. So if you're trading this flag pattern, it's not that it doesn't work, but here's what I want everybody to know, which is very important to know before you start pushing these buttons and why liquidity is important. In order for this thing to continue to jam up, let me just bring this down a little bit and show you what I'm talking about. In order for this thing to manifest into one huge parabolic rally, 2 things have to happen. Liquidity has to be recreated, okay? So the people who want it in back here have to want back in here. The person that may got left out with those 100,000 shares, they have to want to come back up here. You understand this. They have to want to uppay for this asset. So they have to justify in their mind, is this what I want to do right now? And the outcome of that could be hinged on geopolitical factors. Like right now, with tariffs over the market, is that what you want to do? If it's a company earnings, is that what we want to do? If the Fed is going to speak, is that what we want to do? There has to be a reason to change your plan and readapt to the market. Now, this is easier for us to do because we can scalp in and out of that trade. I'm not saying that it doesn't have value, but to really get that magnified, huge, monstrous run. Remember in the introduction, I said you're missing huge, you move after a huge move. It's because we're up top. This is what traditional technical analysis is teaching us. We're actually buying into the sell side liquidity. We're actually selling into the buy side liquidity. And as they say, if you don't understand liquidity, you're becoming liquidity. And that's what most of us are trained to do, because as I also said, if we just continue on, if they're depending on the 90% of the people to continue to lose money in order for them to win. A little bit of a rant there, but let me show you again what I'm talking about. Now, once this sell side order has been developed, right, and you have your failure, right here it is. Notice the spike in volume, which is most likely downside volume, manifests another sell-off, right? This time it blew through the entire low. Now let me show you what this does, okay, to the trader, where this is different, how to avoid max damage. Once you came back down here, right? The first institution, let's focus back on the buy side. You bought, you rally. Now you start to come back down, okay? If you don't show back up, if you don't come back and redefend your position, if you don't take those 100,000 shares, for example, and decide, oh, look, I got back in the trade, let's try it again. If you choose not to do that, it's game over. And it's game over because look at the momentum. It didn't even stop. It blew right through that low without even trying to rally. This is why we need to see those candles. So again, take a look. 1, 2, 3, 4, 5. You have to have some kind of basing. And notice there isn't any basing. There's just a sharp bounce here and there, a sharp bounce here and there, and then failed. What that means is that no one wants that damn liquidity. This is what happens in lopsided markets when you have huge sell-offs in market corrections, like a market correction we're going. It's not about liquidity. Nobody wants it. They just don't want to be anything at all. They'll nibble around and take a scalp or two or take a small trade, but they're not going to just sit here and keep buying the falling knife either. This is what we can't do. We have to look for the basing. We have to look for the reasons now in this chart, just kind of like skipping ahead a little bit. Hopefully I'm making sense. And if I don't, I'm just trying to do my best to cover. We need to find some reason to buy, right? Otherwise, it's just a slow road down. That's what it is. So if we kind of go back, what we're trying to do here first is a step-by-step process in terms of every downward move opens the door in most cases for something to go up. Now, what you're going to see is a lot in charts like this too. Even if the ultimate verdict is lower for the day, there is in fact a tradable bounce. And there, in fact, was a short sell. There's time for us to figure out. So our goal is when we see the move first, we want to try to figure out where will big buyer, where will big seller emerge? Will it be at support? Will it be slightly below support? Will it not even make it that far? Now, this is something that's completely off topic a tad bit, but in your own time, you need to learn things like market cycles. For example, I mentioned our market is correcting now. In a corrective market, you don't want to front run those drops. You really need those bases. That's the whole difference. It's not catching a falling knife. You need those bases to rely on because they're going to give us the clues we need. In really linear, strong, bullish markets, these ranges become condensed, and they become condensed because nobody's going to even wait for liquidity. They're just going to buy at every price because they're not going to be given the luxury of a discount. That's something that you completely have to learn. We've done topics about this. It's also in the gains guide that we produce every week. The link's down there in the description. But back to the point here, now what you're seeing is the lack thereof. See, it's just kind of this low volume nonsense wear out. That's why you hear buyers are tired, sellers are tired. This move is tired. You had the opportunity earlier. You rallied. The rally was short-lived. The sell side liquidity came in. It took the whole market down. So we look for that move first, right? Here's what we're going to do. We start by looking for that move first. We want to look for where the potential reversal is. We need a base. We need a candle to show up a wick. We need 2, 3, 4 candles, something to create a very solid base. And we need to see the volume kind of pick up a little bit. Now, I don't necessarily look at volume at this point, but you probably should if you're starting out with a little bit of volume. We need to see that get lifted, and that's enough. Now, a lot of people will ask me as they do, well, what if you buy it and it blows you through? That's why we use stop losses. But here's the thing. The stop loss of buying up here with a stop loss here is the same as buying here with a stop loss down here. They're the same. The risk is the same. The loss will be the same. But you know what? Not the same is the gain. You made money on that trade if you bought it at the bottom. You did not make any money if you chased it up there at the top. And when we span an entire career, this is all the message I've always been preaching on this channel. Normal technical analysis, normal chart patterns, normal strategies, they have us late. And the only way late entry strategies work is the market has to be lopsided, linear, bullish, all-time high, all-time high, all-time high, day after day after day after day. This is why most people only make money in strong linear bull markets. And as soon as you get blown out, you'll lose, right? That's because that's the kind of market you need in order to get that to work. We can't rely on that. We have to have a strategy that works in every market, and this is it. So once you move up there, The sellers dominate, they create the liquidity, and down it goes. Now, at this point, this late in the day, that's probably got nothing for you. So in a review, I'm going to go ahead. I think I've ranted enough. I get kind of passionate about this stuff. But anyway, I want to thank all of you for being here first. Kind of keep that in mind. Starting now, think about first the sizing. And then think about how that liquidity has to be created in order to get that person. It's the actionable liquidity. It's not just random numbers somewhere on the chart. You just can't be taken random places. You start with the support and resistance from the high and the low of the day. But those aren't guaranteed. As with all technical analysis, it's simply a gauge, just like an indicator. Once we start to move towards, the key is as you get towards support or as you get resistance, you start to look for these candles to develop. Is someone willing to step in? Are these orders willing to continue to be filled? Have they changed their mind? And if you look at this long enough, without any indicators, just candlesticks only, you're going to start to see that tiny little nuance. And if the speed starts to slow and it starts to base, that's an opportunity. I mean, yeah, you may take it and lose, but your losses are so small. And that's what we want to do. We want to keep the losses small and the gains big. But once this move is made, it's over. Once it takes off like that, now you have to re-strategize and possibly look to go to the other side. That's why it's so important for us to catch that early. So anyway, guys, I hope this had enough effect on you like it did me. This was a huge moment for me in my career about just seeing the market completely different, to move away from traditional teaching, traditional technical analysis, and try to align with the smart money. There's smart money concepts out there, but really figuring out what they're going to do first. So when I'm seeing that move, I'm thinking smart money's going to try. Every day they're going to try. Even if the market is bearish, someone is going to try to flip this move, whether it's for a scalp or whether it's to build a position. And that's what we need to look for. So anyway, thanks a lot, guys, for watching today's video. I appreciate it. Take care. Trade well. Cheers.